Hi everyone, welcome back to the channel. In this video, we are going to talk about why gold prices are at all-time highs since 1969. Over the past 20 years, gold has delivered an annual return of about 8.5% in real terms after adjusting for inflation. Over the same period, the S&P 500 has delivered about 8% in real terms, including dividends. So gold has not only preserved value, it has actually competed with equities over 2 decades. That raises an important question. Why is gold rising so strongly now? Is this speculation or is this something structural changing in the global financial system? Let's dive in. So what makes gold different? Gold produces no income, no dividends, no interest. So unlike stocks or bonds, gold's value is not about cash flow. Gold's value is about trust. It is a hedge against currency debasement. It is an insurance against systemic risk. Historically, gold tends to perform well when confidence in paper currencies weakens. To understand today's gold rally, we need to understand currencies then. So what is fiat currency? Most modern currencies are fiat currencies. That means they are not backed by physical assets like gold. They are backed by government decree and public confidence. The US dollar, euro, yen, pound, and yuan are all fiat currencies. Fiat systems work as long as trust remains intact. But when governments run persistent deficits, expand money supplies, and accumulate large debts, purchasing power slowly erodes. This is where gold becomes relevant. So let's understand the dollar's long-term loss of purchasing power a little better. As we talked, over the last 20 years, in real terms, adjusting for inflation, gold's returns have been higher than S&P 500 returns, including dividends reinvested. The US dollar index has declined by about 2.5% annually in real terms after adjusting for inflation through the same period. That means the dollar has steadily lost purchasing power. Over the same period, gold has risen in price largely because fiat currencies have weakened. Gold is not necessarily becoming more valuable, it is often paper currencies that are becoming less valuable. So let's understand why the central banks are buying gold. According to the World Gold Council, central banks have been consistent net buyers of gold, purchasing over 1,000 metric tons annually since 2022. This marks the strongest period of official sector gold accumulation in modern history. Why are central banks buying gold then? Because they want to diversify away from over-reliance on the US dollar. Not because the US dollar is collapsing, but because concentration risk is being reduced. The dollar still represents about 57% of global foreign exchange reserves. A decade ago, it was closer to 66%. The decline is gradual, not dramatic. Economics broadly agree the dollar remains dominant because there is no strong alternative. The euro, yen, pound, and yuan lack global scale, liquidity, and trust. So institutions increasingly turn to gold instead. It is neutral, and it has preserved value for thousands of years. So now let's dive into geopolitics and de-dollarization. Geopolitical risk is another driver. Trade tensions, sanctions, tariff disputes, shifting alliances. These developments push countries to reduce dependence on the US dollar system. Some countries are now settling trade in local currencies instead of dollars. This is often called de-dollarization. This does not mean the dollar is losing its reserve currency status anytime soon, but it does mean gold becomes more attractive as a neutral reserve asset. Gold cannot be sanctioned. Gold does not rely on any government. So now we need to also understand interest rates, treasuries, and the dollar. So another critical factor is the US monetary policy. Markets broadly expect the US Federal Reserve to further cut interest rates over the next couple of years. These decisions directly impact dollar-based assets. They impact US Treasury yields, and they impact the value of the US dollar. When the Fed cut rates, bonds yields tend to fall. The dollar often weakens. and the opportunity cost of holding gold declines. Gold does not pay interest, so when Treasury yields are high, investors prefer bonds. But when yields starts falling, gold becomes more attractive again. At the same time, the US government is carrying over $38 trillion in national debt. It runs deficits every year. High interest rates make debt servicing more expensive, whereas lower rates ease that burden. But lower rates also put pressure on the dollar. This creates a complex environment. In such environments, gold often benefits. So what does this mean for investors? Gold is not a growth asset like equities. It does not compound. It does not generate income. But gold can still serve a role. It can hedge against inflation, currency debasement, and geopolitical instability. It can diversify a portfolio. For most long-term investors, gold should not replace productive assets like businesses, but a modest allocation can add resilience to a portfolio. So in closing, gold's rise is not just speculation. It reflects deeper structural shifts, currency diversification, debt dynamics, geopolitics, and gradual erosion of fiat currencies' purchasing power. Gold does not replace equities, but it complements them. Preserving purchasing power is just as important as growing wealth. Where gold goes next is uncertain. Markets can overshoot in the short term, but the underlying forces driving interest in gold today are real. If you found this useful, consider liking the video and subscribing to the channel. And let me know in the comments how you view gold in your own portfolio. Thank you for watching.